Good morning, how's it going? It is Friday, December 10th, and this is the 0DTE morning market analysis where we check out the market situation, our situational analysis to determine where we're going to put our out-of-the-money asymmetric butterflies for a 0DTE trade. We also like to focus on various aspects of market goings-on, and this morning, the number one issue, the number one thing that we should be paying attention to is the employment situation report. And that's what you see right here. This is the Forex economic calendar. And we have average hour earnings, non-farm employment change, and employment rate coming up this morning in just about, let's see, what time is it? It's 7:42, so about 45 minutes. And the market is all hyped up about this. The implied volatility is really cranked up. That means that we're going to have an opportunity for a pre-morning trade. And so, hey, let's get right to it. Now, as you know, it's important because, not because the Wall Street cares about employment. No. They care about what the Federal Reserve's disposition will be to that report, because the Federal Reserve's two primary directives are maximum employment and stable prices. Now, they seem to fail at both. So anyways, employment has not been a strong issue, although if you're watching the mainstream media, they will tell you otherwise. Of course, that's why you shouldn't watch the mainstream media. You should be listening right here at our analysis, which is down to earth and in line with what most mainstream, or not mainstream, but actual analysts are seeing what the truth is. I'm rambling a little bit here, but anyways, employment has been a weak spot for the economy, and if it is showing more weakness, then, well, weakness will actually be good for the market. Believe it or not, we're in something you call opposite world. Weakness will mean that, the Fed needs to lower interest rates, and maybe they'll accelerate their rate cutting schedule for this coming year. So weakness is good. If it's strong, then the market will believe that the Fed thinks that, we must squash employment. It's going to increase inflation. Of course it doesn't, but that's what they think. So if it's a strong employment report, that'll be bad for the market. Either way, there's going to be plenty of volatility, and that's what we have to look forward to. So, all right, there you go. That's the employment focus. Let's talk about our market situation and what we should expect. So what we need to do first of all is me to get my act together and bring up the VIX. All right. So we can see that compared to Wednesday, that the VIX is slightly elevated at $18.38. That's implying that the width of our out-of-the-money butterflies, our asymmetric flies, should be somewhere between 20 and 30 wide. You can see over here on the left-hand side, there's our out-of-the-money fly width guide range. Right? So we always have a range. Now we have to figure, should we be on the narrow side of that range or the wide side of that range? So what we do up top here, is our other guide, the big ass fly debit price butterfly with, that's a mouthful. This basically is looking at an at-the-money 50 wide fly using the E-mini S&P futures contract. And whatever the pricing of that is, the debit of that will give us a good indication of how the market is pricing implied volatility that morning in options. And from that debit price, we look at that range of prices. If it's a very low price, that means there's much more implied volatility in the market. And we should choose wider flies. If there's a lot of debit or it's very costly, that means that the implied volatility is extremely low and it's going to be a relatively sanguine market, and we should choose much narrower flies. And so that's what that's saying here. So the next step is, I can't believe, am I ready to do this? Hold on. Let's get to our big ass fly. Right there. There we go. All right. The price of the big ass fly is $15.25. Very rarely do you see a price that low on the big ass fly. So that's important. Anything under 25, and we consider that a tradable event. All right, that's what we're looking for is volatility crush after that. Those economic reports are released. With this morning, that will be at 8:30 or about a little bit under 45 minutes from now. But 15 is relatively low. I've seen it as low as 5. No, actually 7, I would say. And that's like a no-brainer trade at that point. But this is a very high probability trade. We're looking for that volatility crush right after the report. We should get a nice increase in premium decay. And that will cause the value of this fly to go up very quickly right after that report from that vol crush event. And if it stays inside of that fly, then we're going to want to stick with it. Otherwise, price may move all over the place, and we have to be very quick on the profits early on. If it stays in the middle of that fly, there's a good chance that we'll get another vol crush event after the morning session has completed, and typically volatility will drop off again, and then we'll get another surge. So that's the beauty of the big ass fly. It's actually a twofer sometimes. Usually one trade, but sometimes you get two opportunities to get a surge in value. So that's what we're going to be looking for. All right. So next step is to go and look at what. Now we're going to switch back to our VIX chart so that we can see where we're at there. And hold on. Go back to trading view. And we can see a value of 25 is way over here. That's definitely in the wide fly column. So we're going to be looking at 30 wide out of the money butterfly today. We do have another strategy that we're cooking up that is another edge case strategy that we call the super wide fly. Actually, that's not the name, but it is a very, very wide fly that we'll put on out of the money trades as well. So we'll be talking about that in the future. If you'd like to learn more about the out of the money butterfly trade, the asymmetric trade, taking small risk, going after much larger profits, where you're containing your drawdowns and the volatility of your returns and going for max return on the capital that you put to use, then go down below and join our Zero DTE Academy. It is the best resource on the internet if you want to learn how to trade options and collect premium on the Zero DTE event. All right, let's move on. So now we know wide flies. Next step is to look at what direction is the market going in. Well, it is still bearish. We're under. I have the Hull moving average here. You can see that we are under the moving average and it's pointing down, so we are bearish. So if we're going to be putting on an out of the money butterfly today, it is going to be a put fly under the market. Of course, anything can happen after the employment situation report, but that is our disposition today. Next step is to look at where the entry events are. We are currently inside of a rather large volume node. Well, not a huge node, but it is a definite volume node, and it is demarcated by this. The top of it is this red line, and the bottom of it is this green line. And these two other lines are just features inside that node that can provide support or resistance. And so those are our market structural elements that we're keying on. And so what we're looking for that out of the money fly, because we're moving down, because our bias is down, we're looking for a pull up to one of these structural lines like this, and then taking a pull up into one of these structural lines. That's what I have right here. I'm making a big mess, right? That line right here shows the beginning of the morning session. So we're looking for a move up into one of these structural lines, whether it's on this blue line or the top of the node or wherever it is. And when that happens and it shows that it's found good resistance there and it's likely to go down, then we'll put our butterfly out of the money, our put fly down here somewhere, right? It's not somewhere. We'll know exactly where it is. It'll be. We know that it's going to be 30 wide and have the kind of risk to reward that we're looking for. Typically somewhere between 1 to 7 to 1 to 12 risk to reward. We start with a standard that will say, hey, try to make that fly debit 10% of the width of the fly. So in this case, if it's a 30 wide fly, we're trying to make it $3. We can go a little under, a little over, because it's hard to always get exactly what you want. But anyways, that's the strategy. And then once we're on that fly, we hope that price comes towards us. If it goes against us, believe it or not, we don't manage it, because that risk that we're taking is a defined risk. And we know that amount of risk taken based on the size of our account will allow us to effectively manage our drawdowns and the volatility of our returns in the long run. So if you look at some of my trade logs, you'll see that I've never really exceeded a 6% drawdown, but typically it stays in the 2 to 3% range. So I'm never drawing down much. I'm always in the game, always within a few trades of making a new high in my account. All right, so that's the overall strategy. That's just about everything. Let's get the big head here. I am finished with the analysis. All right, thank you very much. It's going to be an exciting day. IV is elevated. We have a big event coming up in just a little bit. I have to put on my big ass fly. And again, if you are interested in learning more about options trading on the 0DTE event, go down below. The link is there. Join our 0DTE Academy. It's a school community. You'll have hundreds of other people there, all like-minded professional traders that are there to help. There's courseware, there are resources, there's live events, there's everything. And for just a very small, very affordable, incredible value, just go down below, click that link, and hope you have a great trading day. Good luck. Coach Ernie out.